The harder you work, the more you pay. The more you own, the less you owe. That is not an accident. That is the tax code. If you have spent your career earning a salary, you have been paying taxes the most expensive way possible. And the rules that made it this way were written 100 years ago. Those rules have never been changed. Most people who live inside those rules have never been told how they work. This is the video I wish someone had made before my first paycheck arrived. By the time this is over, you will understand something most people never do. The tax system has two tracks. One for people who work, one for people who own. And you are about to find out which track you have been on. Here is what we are covering. I am going to show you exactly how the two-track tax system was built. I am going to show you the mechanism that makes it legal. For a billionaire to pay a lower rate than a nurse, I am going to show you the documented numbers, proof that it is happening right now. And by the end, I am going to show you the behavioral shift. That determines which track your money moves on for the rest of your life. Let's start with a number that should not be possible, but is. Between 2014 and 2018, the 25 wealthiest Americans watched their combined net worth grow by $401 billion. In those same 5 years, they paid $13.6 billion in federal taxes. That is a true tax rate of 3.4%. The median American wage-earning household paid 14% in federal taxes over that exact same period. A billionaire's wealth growing by tens of billions. A teacher's paycheck taxed at 14% before she spends a dollar. Same country, same tax code, different track entirely. The question is not whether this is happening. The IRS data confirms it is. The question is how. And the answer goes back to November 23, 1921. That is the day Congress signed the Revenue Act of 1921. It was not sold as a gift to the wealthy. It was sold as economic relief after World War I. But buried inside that legislation was a single structural change that is still reshaping your paycheck 100 years later. For the first time in American history, the tax code split income into two categories: income from work and income from ownership. If you earned a salary, your income was taxed at the full rate. In 1921, that rate ran as high as 65%. But if you owned assets and sold them at a profit, your gains were taxed at a flat 12.5%. Same dollars, completely different rules. The mechanism had a name. It was called the capital gains preference. And it has never left the tax code. That decision, made 100 years ago, is still costing working Americans hundreds of billions of dollars a year. Here is exactly how it works. Your salary is taxed the moment it arrives. When you earn money at a job, the government treats that as income. All of it. Your employer withholds the tax before you ever see the check. Depending on your bracket, that rate runs from 10 to 37%. Social Security and Medicare take another 7.65% on top. By the time your paycheck clears, a significant portion of your labor has already moved to the government. Picture a factory where the product gets inspected at the door, every unit, before it leaves. That is how salary income works. The inspection happens first. The worker gets what remains. Investment income waits. If you own stock, and that stock doubles in value, you owe nothing, not $1, until the moment you decide to sell. This is called an unrealized gain. And unrealized gains are invisible to the tax code. A billionaire whose portfolio grows by $500 million this year can pay zero federal income tax on that growth. Zero. Picture the same factory, but now the product sits in a warehouse. No inspection, no tax, until the owner decides to ship it. The owner controls the timing. The worker at the door never does. Your employer decides when your paycheck arrives. A billionaire decides when the government sees their income. That is not the same system. It was never designed to be. When billionaires do pay, they pay less. When a wealthy investor eventually sells an asset held for more than 1 year, the gains are taxed at a maximum of 20%. Your salary can be taxed at 37%. That is a 17-point difference on the same number of dollars. A doctor earning $400,000 a year in salary can pay a higher effective rate than an investor earning $400,000 a year in long-term gains. Same income, different origin, completely different tax bill. Everything in this video is documented public record, but there is a second layer to this mechanism I could not fit here. The exact strategies used to compress a tax bill to near zero, legally and permanently. That breakdown lives inside the Luxona Vault. Link is below if you want in. Now let's keep going. Borrowed money is not taxed at all. Here is where the mechanism becomes almost invisible. When an asset increases in value, a wealthy owner can borrow against it. They use the asset as collateral and take out a loan. A loan is not income. The IRS does not tax borrowed money, so the billionaire spends the borrowed cash, lives on it, buys on it, builds on it, and when the loan comes due, they sell a small slice of the asset, pay capital gains on the sale at 20%, not 37%. This strategy has a name inside financial circles: buy, borrow, die. The asset passes to heirs at a stepped-up cost basis. In many cases, the original gain is never taxed at all. The salary earner pays at source, at full rate, every single pay period. The asset owner controls timing, rate, and in some cases, the tax never arrives at all. The payroll tax trap hits workers hardest. Most people do not realize that income taxes are only part of the bill. Payroll taxes fund Social Security and Medicare. The employee pays 7.65%. The employer pays another 7.65% on your behalf. Most economists agree that employer-side payroll tax is effectively a cost borne by the worker. That means the true payroll tax burden on a wage earner is closer to 15.3%, on top of the income tax, on every dollar earned from a job. Capital gains income faces none of this. Dividends face none of this. Borrowed money faces none of this. Payroll taxes exist specifically because you work. They are designed for the salary track only. The ownership track does not touch them. The rate difference compounds over decades. Here is where this stops being an abstraction and becomes personal. Two people each have $100,000 to deploy. The salary earner receives that as income. After federal income tax and payroll contributions, they keep roughly $65,000. They invest it. The asset owner starts with the full $100,000. No withholding at the source, no payroll tax. The full amount goes to work immediately. Over 30 years at the same return rate, the difference in starting capital alone creates a wealth gap measured in hundreds of thousands of dollars. The tax code did not cause that difference. The two-track system inside the tax code did. Most people pay the highest rate on every dollar they earn. The 25 wealthiest Americans paid 3.4% on $401 billion in wealth growth. That is not a loophole. That is the architecture. But here is what they never account for. The system was built to extract maximum revenue from one specific behavior. That behavior is working for money. The moment money works for you instead, the rules change completely. Not because you broke the system, because you changed tracks. The everyday millionaire is not a person who earns more. The everyday millionaire is a person whose income changes category. They do not find a loophole. They stop earning in the category that is taxed most aggressively. They build assets that appreciate instead of collecting checks that are withheld. They live below their means while that transition happens. They do not rush it. They do not borrow to accelerate it. They do not speculate to shortcut it. They build patiently, deliberately, over years until the math of the tax code starts working in their direction, instead of against it. Most people never make that shift, not because they cannot, because nobody showed them the two tracks exist. They kept working harder on the salary track, assuming the system was designed to reward effort. It is not. It is designed to reward ownership. Effort and ownership are not the same thing. You can have one without the other. The people who understood that early are the ones the data shows paying 3.4%. The people who never understood it are still having taxes pulled from every check before they ever touch the money. The system has two tracks. The track you are on is determined by behavior, not by income, not by inheritance, not by luck, not by the family you were born into, by what kind of money you choose to build. Everything in this video is public record, but there is one mechanism I deliberately left out: the specific ownership structure used to move from the salary track to the capital gains track while paying taxes in between, at the lowest legal rate possible. That is inside the vault. If you want access, the link is below. Now that you understand how income is taxed differently, depending on where it comes from, there is a second system built directly on top of this one. It determines how much of that income you are required to report at all. And the institution behind it has been operating since 1913. That is the next video.